Welcome back to the deep dive. We have quite a stack of documents on the table today that I think a lot of people might, well, frankly, they might initially overlook them or maybe even run away screaming.
I can almost hear it.
It's the source material for the NISM Series V-A Mutual Fund Distributors Certification Examination.
Right. And I can already hear people clicking away, checking their podcast feed to see if they've downloaded the wrong show by mistake.
Exactly. Certification examination.
Sounds incredibly dry, doesn't it?
It sounds like homework. It sounds like something you cram for over a weekend. You pass the test, and then you immediately forget everything.
The mental dump.
But here's the thing. I started reading through Chapter 1, the one titled The Investment Landscape, and I had a bit of an epiphany. I really did. I realized this isn't just a textbook for salespeople or distributors.
No, it's not.
It's basically the hidden manual for how money actually works. It feels like the operating system.
That is the perfect way to frame it. It really is. Most people come to finance and they're looking for what? A hot tip.
Cheat code.
Exactly. They want the cheat codes. But this material, this is the philosophy. This is like the physics of wealth. If you really understand what's in these pages, you aren't just memorizing rules for a test.
No.
You are learning how to structure your entire financial life so that it doesn't, collapse under its own weight down the line.
Yeah.
It's about the foundational psychology and the mechanics that drive every single transaction we make with our money.
And that's our mission for today. We're going to completely bypass the rote memorization. I promise we are not going to quiz you on regulations.
No quizzes today.
We're going to extract the wisdom. We want to take you from just saving money or, having a bank account to being truly well-informed about what that money is actually doing or what it could be doing.
And to do that, you have to start where the deck starts.
Which is with what they call the wrong first question.
Oh, I love this part. It's the trap almost everyone falls into. I mean, it is the single most common pitfall in all of personal finance.
I am absolutely guilty of it. I'm sure you have been too. You're at a dinner party, you meet someone who works in finance, or maybe you just read a headline. And what's the first thing that pops into your head?
What should I buy?
Yes. What's the best investment right now? Is gold a good bet this year?
Should I buy that new tech stock everyone's talking about?
Which mutual fund scheme is the best? It's always about the what.
And the source material just slams the brakes on that immediately. I mean, it critiques this approach so heavily. It points out that asking what is the best investment is exactly like walking into a pharmacy and asking,
what is the best medicine?
Exactly.
And an analogy, it stopped me in my tracks because when you put it that way, it sounds completely ridiculous. Is the best medicine aspirin?
Is it chemotherapy?
Is it a Band-Aid? Is it antibiotics?
I mean, if you don't know the symptoms, if you don't have a diagnosis, the best medicine could actually kill you.
Right. You give chemotherapy to someone with a mild headache.
You have a disaster on your hands. And the text actually references Simon Sinek here.
Yeah.
That whole concept of start with why.
Yes.
The product, the mutual fund, the stock, the bond, the piece of real estate, it's just a vehicle. It's a car. Before you ask which car is the fastest, you have to ask.
Where are we going?
Precisely. What's the destination?
And if I'm just driving 2 blocks to the grocery store, a Formula One car is a terrible choice. It's ridiculously loud, it's expensive, it's impossible to drive in traffic.
And if you're trying to cross the ocean, a Ferrari is completely useless. You need a boat. So the why, your financial goal, dictates the what, the investment product. You cannot separate the investment from the objective.
And that's where most people get it wrong.
It is. They buy the product because it performed well last year or because their friend told them to, not because it actually fits their own personal destination.
So to make this a bit more concrete, the text actually introduces us to a cast of characters. And I want to walk through these because they aren't just random names. They really represent the archetypes of a financial life. They ground this abstract theory in reality.
They do. They represent the different stages of the financial life cycle, the different needs that arise at different points in our lives.
First up, we have Shalini. She's 8 years old. She lives up in North India.
Right. And Shalini is inspired by the space program. She wants to be a space scientist. Now, from a financial perspective, what does Shalini represent to her parents?
A future expense, a big one.
A future liability. That's the technical term. Her parents know that in roughly 10 years, when she turns, say, 18, they're going to need a significant lump sum of money for a specialized and likely very expensive education.
So the timeline is pretty much fixed 10 years. The goal is clear education funding.
And importantly, she has time on her side.
Yeah.
That is the single most valuable asset. It changes the risk profile completely. Her parents can afford to take some calculated risks now because they have a full decade to ride out any market volatility.
They're in the growth phase.
They're in the growth phase for this specific goal, yes. They can plant the seed and let it grow.
Okay, so let's contrast that with Mrs. D'Souza.
She's at the absolute other end of the spectrum. She's a retired teacher. She has just received her retirement benefits, a lump sum of cash. Her why isn't growth. Not at all.
It's income.
It's survival. It's consistency. She needs that pile of money to generate a monthly paycheck, a pension for herself, to buy groceries, pay for medicine, handle the electricity bills.
So if Shalini's parents invest in something volatile that drops, say, 20% next year, it's not great, but it's okay.
It's recoverable.
They have 9 more years to recover and grow. But if Mrs. D'Souza's money drops 20%,
she might not eat properly that month. That's the reality. The best investment for Shalini, maybe a high-growth equity fund, is likely the absolute worst investment for Mrs. D'Souza. She needs stability. She needs capital preservation.
she cannot afford a drawdown.
No, she needs liquidity and predictable income.
Okay. Then we have Rabindra. He's 45. He works as an engineer in a multinational company. He's what we might call the sandwich generation.
The classic accumulator. He's earning, well, he's at the peak of his career, but, and this is a big odd, he has a glaring gap in his financial armor.
No pension.
No pension, and it's hitting him. He's realizing that one day the paycheck stops, but the expenses, they won't. He has a shorter runway than Shalini's parents, maybe 15 years until retirement, but he has the cash flow right now to invest aggressively.
So his goal is...
Corpus accumulation.
Yeah.
Building the biggest pile of money he possibly can before he retires.
And finally, Surinder Singh. He's the young guy, just got a promotion, moved to a big city, and he is just sick and tired of house hunting. He wants to buy his own place.
The asset acquirer. This is a very different goal. He needs a large down payment, and he needs it relatively soon. Let's say in 3 to 5 years.
A target date goal.
Exactly.
Yeah.
And that means he can't afford to have his savings wiped out right before he needs to sign the deed. Imagine if he invests his down payment money in the stock market and the market crashes the week before his closing date.
He loses the house.
He loses the house. So his risk appetite is, by necessity, very different from Rabindra's, even if they're both earning well.
The text makes a really, really interesting distinction here about these stories. It says these life events, getting an education, retiring, buying a house, are just financial objectives. They only become financial goals when you add 2 specific ingredients.
Math and time.
Exactly.
I want to be rich is a fantasy. It's a wish. It's not a goal. I need 5 crores. It's better, but it's still incomplete.
But I need 5 crores in 15 years.
Now, that is a financial goal. Once you have the amount and the time horizon, you can actually start to build the bridge to get there. You can work backwards. Without those 2 numbers, you're just guessing. You're flying blind.
And this leads right into the concept of the goal matrix. The text contrasts this with what it calls the pool approach. And I think the pool approach is how, honestly, 90% of people operate.
Oh, it's incredibly intuitive. It's the default setting for most of us.
Yeah.
You have a savings account, that's the pool. You get your salary, pay your bills, and you dump whatever money is left over into it.
It's a catch-all.
It's a total catch-all. That money is for the wedding, the car, the retirement, and the emergency trip to the dentist. It's just money.
So why is that so dangerous? It feels simple.
It's dangerous because money is fungible, but goals are not. They have different timelines. If you have one big pool, you might look at the balance and say, wow, I have plenty of cash. Let's go on that luxury vacation to Europe.
And you spend it.
You spend the money. But what you don't realize is that you just spent the money that was mathematically required to sit and compound for the next 20 years to pay for your retirement.
You robbed your future self.
You robbed your future self to treat your present self, and you didn't even know it because it was all in one big, confusing bucket.
It's a duration mismatch, as they'd say in finance.
It's a massive duration mismatch. You need distinct buckets. A short-term bucket for the vacation, which should be in something safe, a medium-term bucket for the house, and a very long-term bucket for retirement, which can be in growth assets. You wouldn't use the milk you bought for next month's cooking to make an omelet today if you knew you couldn't buy more milk later. It's the same principle.
The source material actually references Stephen Covey here from the 7 Habits of Highly Effective People. I really did not expect to see self-help literature in a finance certification guide.
Me neither. But it makes so much sense when you look at his urgent versus important matrix.
It fits perfectly.
It really does. Covey talks about 4 quadrants. Quadrants is urgent and important.
The crisis quadrant.
Yes. That's a heart attack. That's a car crash. That's a sudden job loss. You need money right now.
And quadrant 2.
That's the important one for this discussion. Important, but not urgent. This is Shalini's education fund. This is your retirement planning. This is estate planning.
There's no deadline tomorrow.
Exactly. No one is banging on your door asking for your retirement money today. The bill isn't due for 10 or 20 or 30 years.
And that's the trap.
That is the ultimate trap. Because it's not urgent, we push it aside. We say, oh, I'll start saving for retirement next year. Right now I have to pay for the car repair. But the text argues, and I think it's absolutely right, that most financial failure happens because people ignore quadrant 2 until it becomes quadrant 1.
And suddenly Shalini is 18.
Suddenly she's 18, the college admission fees are due tomorrow, and you don't have the funds. What was a not urgent problem for a decade has now become a full-blown crisis.
And you have to take a high-interest loan or sell an asset at a bad price.
You're forced into making bad decisions. Investing, really, is the discipline of managing quadrant 2. While it is still peacefully sitting in quadrant 2, it's taking care of the future before the future becomes a crisis.
But while we are sitting around procrastinating on quadrant 2, thinking we've got all the time in the world, there is something that is, well, it's eating our lunch.
Every single day.
We have to talk about the silent erosion.
Inflation.
The text calls this inflation risk, but I feel like risk is too soft a word. A risk implies something might happen. Inflation feels more like a guarantee.
It is a statistical certainty in any growing economy. And this is the part of the conversation that usually shocks people when we run the actual numbers. We tend to think in what are called nominal terms. I have 10,000 rupees in my safe. Next year, I open the safe, and I still have 10,000 rupees. I haven't lost anything.
But you have. You've lost the ability to use it.
You have lost purchasing power. And the source gives a very specific and I think very powerful calculation to drive this home.
Let's hear it.
Let's say you have Rs 10,000 today. And let's assume inflation is running at 8%, which, by the way, is a pretty realistic historical assumption for a developing economy like India over long periods.
Okay.
In just 5 years, to buy the exact same basket of goods, the same bread, the same milk, the same petrol, you would need Rs, 14,693.
Wow. That's almost a 50% increase in the cost of living.
Roughly, yes.
Yeah.
So if you keep your 10,000 rupees under a mattress, or even in a savings account earning, what, 2% or 3%?
You've become poor.
You have effectively become 30% to 40% poorer in terms of what you can actually do with your life. You have the same number of rupees, but they're smaller rupees. They buy less.
This brings up the huge concept of real versus nominal returns. And I think this is where people really get fooled by banks and advertisements.
This is the most critical metric in the whole book, in my opinion. The nominal return is a headline number. It's what the bank advertises. Fixed deposit, 6% interest.
Sounds great.
It sounds great. The number in your account goes up. You feel richer. But if inflation is 8% and you were earning 6%,
you're losing 2% every year.
Your real return is negative 2%.
Mm-hmm.
You are on a treadmill, and someone is slowly increasing the speed, but you're running backwards. You are becoming poorer safely and slowly.
Becoming poorer safely.
It's a hard concept for people to grasp because the number in the bank account is growing. It's a complete illusion of wealth.
That phrase, becoming poorer safely, is terrifying. And it transitions us perfectly to the distinction the text makes between saving and investing. I have to admit, I always thought they were basically synonyms. I'm saving in the stock market. I'm investing in a savings account.
We mix them up all the time in casual conversation. But in the investment landscape, they are practically opposites. They serve completely different masters.
The notes here even mention the etymology of the word. The root word of saving is safe.
Right, and that's the whole point. Saving is about preservation of capital. It's about storage. It is money you have set aside for consumption in the near future. The priority for savings is safety and liquidity.
You need to get it quickly.
You don't care if it grows much. You just need it to be there when you reach for it. This is your emergency fund. This is money for quadrant crises.
And investing.
Investing is about profit. It's about growth. The text defines it as the specific trade-off you make. You are willing to take on risk, the risk of losing money or the risk of locking it away for a period of time in exchange for a return that beats inflation.
So saving is just the act of not spending.
Right, it's deferred consumption.
And investing is what you do with that unspent money to make it grow.
Ideally, yes. To put it simply, saving protects you from today's emergencies. Investing protects you from tomorrow's inflation.
And you absolutely need both.
You need both, but you cannot confuse their roles. If you invest your emergency fund in the stock market and the market crashes right when you lose your job, you're ruined.
And if you save your retirement money in a bank account,
Inflation will eat it alive, and you'll run out of money when you're 75.
yeah.
It's about using the right tool for the right job.
So how do we evaluate where to put this money? If we've saved it and now we're ready to invest it, what are we looking for? The text outlines 3 core parameters, the iron triangle.
Safety, liquidity, and returns.
And of course, we want all 3. I want an investment that is 100% safe. I can withdraw it instantly from any ATM, and it pays me 20% interest like a high-growth stock.
And I want to eat pizza for every single meal and have 6-pack abs. It doesn't exist.
Right.
The text is very clear about this. There's always a trade-off. It is the iron law of finance. You can have any 2, but you can't have all 3.
Okay, break that down.
If you want high safety and high liquidity, like a bank savings account, you must accept low returns. If you want high returns, you must sacrifice safety, so take on risk, like with stocks. Or you must sacrifice liquidity, meaning you lock it away for a long time, like in real estate or a long-term bond.
There are some secondary parameters mentioned too, things like ticket size and taxability.
Right. Ticket size is just the barrier to entry. Commercial real estate in a big city has a huge ticket size. You might need crores to even get in the door.
Whereas a mutual fund?
Has a tiny ticket size. You can start with 500 rupees. That matters for accessibility. But taxability, now that is the silent killer of returns.
It's not what you earn.
It's what you keep. If product A gives you a 10% return, but it's taxed at your income slab of, say, 30%, you only keep 7%. If product B gives you an 8% return, but it's tax-free, product B is actually the better investment. You have to look at the post-tax real return. That's the only number that matters.
So let's look at the menu of options, the asset class landscape. The source material breaks this down into 4 main categories: real estate, commodities, fixed income, and equity. I want to start with real estate because the text takes a bit of a controversial stance here. It challenges the Indian obsession with property. We love buying houses.
It really does challenge the cultural narrative. The text explicitly states that a self-occupied house, the one you live in, should be considered an expense or a form of consumption, not an investment.
Wait, explain that. My house value goes up. My uncle bought a house in 1990 and sold it for 10 times the price. That sounds like an investment to me.
The value goes up on paper, yes, but think about the utility. You live in it. It provides you with shelter. That is consumption, like eating food or wearing clothes.
Yeah.
To realize that gain, you have to sell it.
Okay.
But if you sell your house, where are you going to live? You have to buy another house. And if the market is up, the new house you have to buy is also expensive. You haven't actually generated any deployable wealth unless you significantly downsize or move to a much cheaper city.
Plus, it's indivisible.
Exactly. I love that term. You can't sell the guest bedroom to pay for groceries if you have a financial
So
emergency.
you can't sell a bathroom.
It's lumpy, and it's incredibly illiquid. In a crisis, you can't sell a house in 24 hours. It can take months, sometimes years, to find a buyer, negotiate a price, and do all the paperwork.
Government transaction costs are huge.
Massive. Stamp duty, registration fees, brokerage, ongoing maintenance, property tax. The text argues that when you factor all of that in, plus the enormous interest you probably paid on the loan, the real returns on a self-occupied house are often much, much lower than people think. It has a way of keeping you poor in cash flow terms while making you look rich on paper.
That is a heavy reality check. Okay, what about commodities? Specifically gold. We love gold in this country. It's almost a religion.
We do. It's deeply cultural. But the text highlights a few practical problems. First, the purity problem. With physical gold, like jewelry or coins, unless you are an expert assayer, you don't really know what you're holding. Is it 22 karat? Is it 24 karat? Is it mixed with other metals?
There's a trust issue.
There is.
Yeah.
But the biggest knock against commodities in the source text is that they do not generate current income.
That's a key phrase, current income. What does that mean exactly?
Think about it this way. A bond pays you interest. A stock can pay you dividends. A rental property pays you rent. Those are assets that work for you. They produce a cash flow while you own them.
But gold just.
Gold just sits there. In a vault, it has no internal engine. It doesn't produce anything. Your entire return is dependent on what's called the greater fool theory.
Which is?
You need someone else to come along in 5 years and be willing to pay more for it than you did. That's it. It's purely speculative price appreciation. It might be a store of value against chaos, perhaps, but it's not a productive asset.
Okay, let's move to fixed income. The text calls these lending assets.
And this mindset shift is really helpful. When you buy a bond, or you put money in a fixed deposit, or you buy a debenture, you aren't investing in some vague sense. You are becoming a banker. You are lending your money to a counterparty.
And that counterparty could be the government or it could be a company.
Right. And because you are a lender, you have a contract. The contract says, I promise to pay you X% interest every year and return your principal on this specific date.
This creates a clear hierarchy of safety.
Very clear. If you lend to the government by buying GSECs, it's considered risk-free in terms of default because the government has the unique ability to print more money to pay you back. It has a sovereign guarantee. If you lend to a corporation, you have to worry, will their business fail? Will they go bust? That's credit risk.
And finally, the big one, equity. The text calls these ownership assets.
Yes. So if fixed income is like being a banker, equity is like being a partner. You are buying a small slice of the business. You become a part owner.
And the text calls this risk capital.
It is the ultimate risk capital because there is no contract. There is no promise of returns.
None at all.
None whatsoever. If the business makes zero profit, you get zero dividends. If the business goes bankrupt, you are the last in line to get paid. After the employees, after the tax man, after all the lenders, the bondholders, you might get absolutely nothing.
However.
There's always a however with equity.
There has to be.
The upside is theoretically unlimited. If you lend money to, say, Apple by buying their bond, you get your 5% interest. That's the end of the story. If Apple then invents the next iPhone and the company's value grows by 1,000%, the lender
Still only gets 5%.
Exactly. But the shareholder, the owner, gets to participate in that 1,000% growth. That is the mechanism. Share prices follow business profits over the long term. You are participating in human ingenuity and economic growth. You are betting on the company succeeding spectacularly, not just surviving.
The text also touches on international exposure within equity. Why is that an important point to bring up?
It's about diversification, but it introduces a new variable into the mix. Currency risk.
Right.
If you, sitting in India, invest in U.S. stocks, you are actually making two bets. The first bet is that the U.S. companies will do well. The second bet is that the U.S. dollar will get stronger, or at least stay stable, against the Indian rupee.
And if that second bet goes wrong?
If the rupee strengthens significantly, say, it goes from 80 to $1 down to 70 your investment value, when converted back to rupees, drops, even if the stock price stayed perfectly flat in dollars, it adds a layer of complexity, but it also gives you a liquor of protection against your home currency devaluing over time.
This transitions us perfectly to what is often the scariest part of these documents. We've talked about the vehicles, the what. Now we need to talk about the crashes, the fear. Segment 4, the anatomy of risk.
You know, risk is often misunderstood. People think risk is just this big, scary cloud of losing money. But the text does a great job of breaking it down into very specific mechanical failures. It's like diagnosing why a car stopped working. Was it the engine? Was it the tires? Or did you just run out of gas?
The big distinction the text makes right at the top is systematic versus unsystematic risk. These sound like really fancy academic terms, but the concepts are actually quite simple.
They are. Think of it this way. Unsystematic risk is like your specific car breaking down. It's a problem unique to you or to that one specific company. The CEO commits fraud. The main factory burns down. The workers go on a prolonged strike. A key product gets recalled by regulators. It affects that one company, but not the whole economy.
And how do you fix this?
You don't drive just one car. You own a fleet. If you own 50 different stocks and one of those companies has a strike, your total portfolio might drop by, 2%? You survive.
So you can diversify it away.
The rule is, unsystematic risk can be diversified away. It's a solvable problem.
Okay, so what is systematic risk?
That's the massive traffic jam. That's the entire road washing away in a flood. It doesn't matter how good your car is. If the road is closed, no one is moving.
It affects everyone.
Everyone. This is war, pandemics, a global recession, a sudden spike in interest rates. When these things happen, everything falls. Stocks, real estate, sometimes even bonds.
And you can't diversify this away.
You absolutely cannot diversify away systematic risk. When the tide goes out, all the boats go down, no matter how fancy they are.
And here is the nugget from the text that blew my mind. The market compensates you, it pays you, for taking one of these risks, but not the other.
Correct. This is so fundamental. The market pays you what's called a risk premium, the potential for higher returns, for taking on systematic risk. Why?
Yeah.
Because you have no choice.
Yeah.
You have to face the turbulence of the overall market to get the growth.
But for unsystematic risk,
The market pays you zero. Absolutely nothing. Why? Because you could have easily avoided it by diversifying. If you bet everything you have on one single company and it goes bankrupt, the market effectively says, that's your fault. That was a lazy risk. You should have just bought the index.
That is a brilliant way to put it. The market doesn't pay you for taking lazy risks.
Exactly. Don't take risks you don't have to take. Diversification is the only free lunch in finance, and you should eat it.
Okay, I want to drill down into a specific risk that confuses almost everyone, interest rate risk. The text describes an inverse relationship.
This is the teeter-totter of the bond market. It's a core concept. When interest rates in the economy go UP, existing bond prices go down in MAR.
Can we walk through an example? Because that feels very counterintuitive. If REITs go up, shouldn't my investment be worth more?
Only if you are buying new bonds today. Think about the bond you already own.
Okay.
Imagine you bought a bond yesterday for Rs 100. It's a government bond, and it pays 6% interest. You're happy.
I'm getting my 6% a year.
You are. But today, the central bank raises interest rates to combat inflation. So now, brand new government bonds are being issued that pay 7%. Now, you decide you need some cash, so you want to sell your old bond. You go to a buyer and say, hey, buy my bond, it pays 6%. What does the buyer say?
They'd say, why would I pay you Rs 100 for your 6% bond when I can just go buy a brand new one for Rs 100 that pays 7%? They'd laugh at me.
They'd laugh you out of the room. So to convince them to buy your less attractive bond, you have to lower the price. You have to offer to sell it for, say, Rs 98. At that discounted price of Rs 98, the math works out so that the effective yield on your old bond now matches the new 7% market rate.
And that drop in price.
That drop from 100 to 98, that is interest rate risk. You lost capital value on your safe investment because overall rates in the economy went up.
And the text notes that longer maturity bonds suffer more from this.
Much more. If you were locked into that low 6% rate for 30 years, it's a much bigger problem than if you're only locked in for 3 more months. The longer the bond's maturity, the more sensitive its price is to changes in interest rates. A 30-year bond price can swing wildly, almost like a stock, when rates move.
Then there's credit risk. The text has a fascinating nuance here. It distinguishes between the ability to pay and the intention to pay.
This is the difference between misfortune and malice. It's a critical distinction.
How so?
Ability to pay. This is about the business itself. The company wants to pay you back your loan, but they can't. Their business model failed. Competitors crush them. They are genuinely bankrupt. That's a commercial risk.
And the intention to pay.
The company has the money, but the promoters are siphoning it off into their personal accounts. They're committing fraud. They're fleeing the country. That is a governance risk.
And as an investor, you have to guard against both.
Absolutely. Rating agencies are pretty good at measuring the ability, but intention is much harder to gauge. That requires deep dives into corporate governance and the character of the management.
So given all these different types of risk, how do we manage them? The text lists 3 main strategies: avoidance, positioning, and diversification.
Right. Avoidance is the simplest one. Don't buy what you don't understand. If you can't explain how crypto works to a 10-year-old, don't buy it. If you don't understand complex derivatives, stay away. It's about knowing your limits.
Position.
That's for the pros, or at least people who think they are. That's actively betting on the future. I think interest rates are going to fall, so I'm going to load up on long-term bonds.
It's market timing.
It's market timing, and it requires you to predict the future, which is, let's say, incredibly difficult.
And then diversification?
Which is the most prudent strategy for almost every lay investor. It's the humble admission that you don't know what the future holds. So you spread your bets. You invest across different asset classes, across different sectors, across different geographies. It's the only strategy that ensures one single disaster doesn't wipe you out completely.
And this is where the text gets really, really interesting. It suggests that the biggest risk to your wealth isn't the market or the economy or even a specific company.
No. The biggest risk is the person you see looking back at you in the mirror every morning.
Segment 5, the human element.
Behavioral biases. The expert in me usually chuckles at this part because, honestly, the math of finance is pretty simple. It's 5th grade math. Addition, subtraction, percentages, compounding. It's easy.
But the psychology.
The emotions of finance are incredibly hard. We are evolutionarily wired to be terrible investors. Our brains were designed to survive on the savannah, not to navigate the stock market. We are wired to run from danger, which means selling when markets drop, and run toward food, which means buying when markets are in a bubble.
Let's run through the specific biases listed in the source material. First up, Availability heuristic.
This is our brain being lazy. It's a mental shortcut. We judge the probability of an event based on how easily we can recall an example of it.
So if I just saw a plane crash on the news,
You're going to think flying is much more dangerous than it actually is, even though statistics show it's the safest form of travel. In finance, you watch the news, you see a story about a stock market crash. It's vivid. It's scary. So your brain concludes, stock markets crash all the time. It's too dangerous for me.
and you ignore the data.
You completely ignore the decades of data that show the market went up slowly and steadily, because slow, boring growth isn't a headline. You prioritize the vivid, scary story over the boring long-term data.
Okay, next. Confirmation bias.
This is the echo chamber we build for ourselves.
Yeah.
Let's say you decide you love Tesla stock.
Yeah.
You will then subconsciously seek out articles and videos that say Tesla is going to the moon. And you will scroll right past the articles that say Tesla is dangerously overvalued.
You're not looking for information.
You're not researching to learn. You are researching to feel good about a decision you have already made. You are seeking validation, not truth. And that is a very dangerous way to invest.
Familiarity bias. This one feels huge in India, doesn't it?
Oh, it's massive. It's the old saying, a known devil is better than an unknown angel. We invest in what we see and what we know. We buy property in our own neighborhood. We buy stocks at the bank we use or the car company we drive.
What's the problem with that?
The problem is it creates enormous concentration risk. If you live in Mumbai, you work for an IT company in Mumbai, and you own 3 investment properties all in Mumbai. What happens if there's a localized economic downturn in the Mumbai IT sector or a natural disaster?
Your whole life gets ruined. Your job and your investments.
Exactly. You need to diversify away from what is familiar to protect yourself.
That leads directly to the interest of the investor point the text makes.
This is a really subtle but powerful one. It refers to your human capital, your career.
Okay.
Imagine you are a software engineer at a top tech firm.
Yeah.
Your income, your bonus, your future career growth, it's all tied to the health of the tech sector. If you then take all your savings and invest only in tech mutual funds,
You're doubling down.
you are putting all your eggs in one single basket. If the tech bubble bursts, you could lose your job. And D, your entire portfolio could crash at the exact same time. It's a catastrophic risk. You should actually be hedging your career. If you're in tech, maybe you should be investing in pharma or consumer goods. If you work in banking, maybe you should invest in manufacturing.
That is such a smart, actionable takeaway. Don't invest in your own paycheck. Okay, next one. Herd mentality.
FOMO, pure and simple fear of missing out. This is what creates bubbles. Everyone starts buying because everyone else is buying. No one is looking at the underlying value anymore.
My neighbor bought crypto and made a ton of money.
So I must do it too, or I'm an idiot. And then, when the market inevitably turns, everyone panic sells because everyone else is panic selling.
You buy high and sell low.
The text emphasizes that truly successful investing often feels very lonely. You have to be comfortable buying when others are fearful and selling when others are greedy. You have to walk away from the herd.
And finally, the big one. The one that I think drives so much irrational behavior, loss aversion.
This is deep in our reptilian brain. It's a survival instinct. Psychological studies have shown that the pain of losing Rs 5,000 is about twice as intense as the pleasure of gaining Rs 5,000.
We hate losing more than we love winning.
By a factor of 2. And because of this, we will do incredibly irrational things to avoid realizing a loss.
Well,
We will hold on to a loser stock for years and years, praying it goes back to our buy price just so we can sell it and break even. We refuse to admit we made a mistake.
and what do we do with our winners?
We sell our winner stocks way too early, just to lock in that good feeling of a profit. So we end up with a portfolio of our worst ideas because we sold all our best ones. It's the exact opposite of the golden rule of investing.
Which is?
Cut your losers short and let your winners run.
And one more, recency bias.
That's just thinking the future will look exactly like the immediate past. The market has been going up for 6 months, so it will keep going up. Or, real estate's been flat for 2 years, so it will always be flat. We extrapolate the very recent trend into the indefinite future and forget about long-term cycles.
So we've established that the market itself is risky, and our own brains are actively working against us. How on earth do we actually structure a portfolio that can survive all of this? This brings us to segment 6, exit allocation.
This is the how. This is where the rubber meets the road. And it all starts with risk profiling. But the text nuances this beautifully. It doesn't just say find your risk profile. It breaks risk into 3 competing and sometimes conflicting components: need, ability, and willingness.
I love this breakdown. Let's unpack them one by one. First, need.
Need is purely mathematical. It's a calculator function. You plug in the numbers. I need 5 crores for retirement. I have 20 years to get there. I can save 50,000 rupees a month. The math might spit out an answer. To hit that goal, you need to earn a 12% annualized return. That's your required rate of return.
Okay, then, ability.
Ability is your financial strength. It's your balance sheet and your cash flow. I have a steady government job. I have no loans. I'm only 30 years old. This person has a high capacity or ability to take risk. If they lose some money in the market, they have decades of earning potential to make it back.
And finally, willingness.
This is purely psychological. It's the sleep test. If the market drops 10%, do you check your phone every 5 minutes? Do you feel sick to your stomach? Do you panic? Some people, no matter how rich or financially secure they are, just cannot handle volatility. They have a low willingness to take risk.
And the conflict arises when these three don't align.
That's where all the problems start. The classic mismatch is when the need is very high. I need to get rich quick, but the ability is very low. I have no savings and an unstable job.
That's a recipe for disaster.
It is, because that investor will be tempted to take huge risks, maybe by gambling on speculative assets to try and bridge that gap. But they can't afford the loss if it goes wrong.
So what's the solution?
A good financial advisor or a smart self-directed investor looks at that mismatch and says, we can't just magically increase the market returns. We have to change the other variables. We have to change the goal, maybe retire a few years later, or we have to change the input, find a way to save more money. You don't solve a math problem by taking reckless risks.
The text also discusses the difference between strategic and tactical asset allocation.
Right. Strategic is your baseline diet. It's your long-term plan. I will eat healthy 90% of the time. In finance, that translates to, based on my risk profile, I will keep 60% of my money in equity and 40% in debt. And you stick to this through ups and downs. You rebalance periodically. If equity has a great year and grows to 70% of your portfolio,
You sell some of it.
you sell 10% of the equity and buy more debt to get back to your 60-40 target. It forces you to sell high and buy low.
And tactical.
Tactical is trying to be a master chef. It's short-term deviation. Oh, I think the market looks really cheap right now, so I'm going to temporarily go up to 80% equity. It's timing the market.
And the text warns against this.
It gives a very strong warning. Tactical allocation is incredibly difficult to get right consistently. It requires you to make 2 correct decisions, when to get in, and, just as importantly, when to get out. Most people get in at the top and get out at the bottom. It's a game best left to professionals with huge research teams.
Which brings us to our final dilemma, the do-it-yourself versus professional debate. This is segment 7.
Of a very modern debate.
It is. We live in the age of apps. I can buy a stock or a mutual fund on my phone while I'm waiting for a coffee. It seems so easy. Why should I pay a distributor or a fund manager? Why not just DIY?
This is the DIY myth. And it looks cheaper on the surface because you don't always see a direct fee being debited. But the text does a great job of analyzing the hidden costs of DIY.
Let's talk about those.
First and foremost, the value of time. To do this right, to actually research companies, analyze balance sheets, track macroeconomic trends, read annual reports, it takes hours and hours every week.
It's a part-time job.
It is. So if you're a professional earning a good salary, what is your time worth per hour? If you spend 10 hours a week playing amateur fund manager just to save a 1% fee on your portfolio, you are probably working for less than minimum wage. You are stealing time from your actual career, from your family, or from your health.
And then there's the emotional cost.
This goes right back to the biases we just talked about. If you are managing your own money directly, there is no buffer between you and your emotions. When the market crashes, you are the one who has to log in and press the sell button. You are far more prone to panic.
Whereas a professional.
A professional, like a mutual fund manager or a good distributor, acts as a circuit breaker. They are, or should be, unemotional about your money. They are following a process, a mandate. In many ways, their biggest job is to save you from yourself.
And the text defines the role of the mutual fund not just as an investment, but as a vehicle.
Yes, it's a trust, legally. It pools the money of many investors, and that gives you incredible economies of scale.
What does that mean in practice?
If you have just Rs 500 to invest, you can't build a diversified portfolio. You can't even pay the brokerage to buy 50 different stocks. But a mutual fund takes your Rs 500, combines it with crores of rupees from millions of other people, and buys the entire market on your behalf. You get professional management, instant diversification, and high liquidity, all for a tiny ticket size. It solves all the operational problems so that you can focus on the big strategic problems, like your asset allocation.
So, looking back at this entire landscape, we started with little Shalini wanting to go to space.
And we realized that to help get her there, her parents don't need a hot stock tip.
Yeah.
They need to define the goal and put it in quadrant 2.
Yeah.
They need to understand the silent erosion of inflation and choose investing over just saving.
They need to pick the right vehicle, probably equity for a long-term goal, and avoid the wrong ones, like physical gold or a self-occupied house for that specific goal.
They need to diversify to protect against the known risks, both systematic and unsystematic. And most importantly, they need to master their own psychology, their own biases, so they don't panic and sell when things inevitably get rocky.
It's a complete journey from why we invest all the way to how we do it.
It is.
Yeah.
It transforms finance from what looks like a gambling game into a goal-oriented engineering process.
Before we sign off, we always like to leave our listeners with a final provocative thought, something to chew on that builds on everything we learned today.
Here is the flip, the inversion I want you to consider. We spend our whole lives being told that saving is safe and investing is risky.
Right. The stock market is a casino, the bank is a fortress.
That's the narrative. But look at the math we discussed. In a world of, say, 8% inflation, safety, putting your money in a savings account earning 3% guarantees that you will become poorer over time. It is a guaranteed loss of purchasing power. It guarantees the erosion of your life's work.
So safety is a guaranteed loss.
A guaranteed real loss. Whereas risk investing in growth assets like equity that have the potential to outpace inflation is the only thing that offers you a chance to maintain and even grow your purchasing power over the long term.
So the question is,
Ask yourself this: is your definition of safety actually the most dangerous choice you can make for your future? And is taking calculated risk actually the only truly safe path to get where you want to go?
safety might be the ultimate risk. That is a powerful thought to end on. This has been a deep dive into the investment landscape based on the NISM certification material. We hope you feel a little more certified in the School of Life today.
Keep asking why.
Thanks for listening. We'll catch you on the next deep dive.